So MQA yesterday put out its quarterly traffic data. Look, what I really focus on here is what's happening on their APRR asset. Makes up about 90% of the equity valuation, so really the one to focus on. And the traffic over in France has been going very well, certainly well above their long-term growth rates. And the thing that really stood out to me is their heavy vehicles. The growth in that was about 8% year on year, so really indicative of that sort of recovering European economy. Target price up 37 cents per share, now sitting at $6.61. Closed yesterday at $5.79. So that's the target. The distribution outlook, I can see close to like a doubling of the distribution between FY17 and FY20. So certainly a lot of strength coming through there. The positives that I see coming through on this stock, that ongoing traffic strength continuing to come through. Substantial interest cost reduction should come through this year. They've got these massive interest rate hedges that are really expensive that will fall away, and they'll have instantaneous interest cost savings on that front. And there's expensive debt that's also going to get refinanced. So that'll come through sort of second half of this year and really benefit 2019. And then in the medium term, France tax rate cut. So 2017 underlying tax was 34%. The government put on this extraordinary tax, took it to 39%, but they have legislated cuts to come through down to 28% in 2021. And then just during the break, another tax rate cut legislated for 2022, taking that 28 down to 25%. So real kicker coming through there for them. And because this asset is in France, obviously it's European denominated, euro denominated, the Aussie euro, I'm setting the valuation and forecast based on spot. But if Noxie's correct and we get a mid 50s type Aussie euro cross, then it's not difficult to actually get a mid to high $7 valuation for this stock, just literally just on that change in the on the FX assumption. Key risks on this one, number one is internalisation. So they're going through the process of internalising management. We just do not know how much fee leakage there will be across to Macquarie on this front. I've tried to factor in what I think is reasonable, and the funding of that being through additional share issue coming through. Also, the bond rates are potentially ticking up, but just want to point out in France, bond rates are still well below 1%, and the Euribor, which is the equivalent of the Aussie sort of bank bill rate, I checked last week, it's sitting at minus 30 bips. So still very much a very low interest rate environment in Europe, which supports the equity valuation for the APRR. And to me, that internalisation simplifies MQA and really sets it up for it to being a potential takeover target. I can't believe that there wouldn't be some European pension funds that would be looking at the APRR as a tasty asset to hold, particularly given they're looking down the barrel of these very low bond rates still.